what's leading the losses is the Kospi, the Korean market, that is down 1.3% right now.
Fed doubled its growth forecast to 2.1% this year.
Banks and brokerages still quite bullish on crude.
The 50% retracement is 19,723.
While the stock down, the floor price for this particular OFS is at 69 rupees a share.
Morgan Stanley has an equal weight rating with a target at 425 rupees a share. First tick that we're getting on the index this morning, it's down about 78 points.
Because the primary purpose with which we have started this journey is to make BSE vibrant.
So we can expect a very large volume this month as well.
I think we have to brace for higher inflation.
Our current order book stands at around 2,000 crores.
Firmly down day for our markets, 19,750, 150 points lower.
The dot chart in June had indicated 4 cuts in 2024. Today's chart indicates only 2 cuts.
Talking about more details, MEA is yet to respond.
Turning out to be a session where we are seeing that pressure, which is relentless, you'd have to say, for the financials.
Well, that is the day so far. You're with us here on a fresh new edition of Closing Bell. We're coming to you live from the CNBC-TV18 News studios. And, what to say about the market, about the fact that we've been down and out from the word go. Absolutely no respite. We're at 19,732. It's been that way from the morning. Not even a sign of a bounce. Maybe a little one, but that was early on in the first half of the session. But since then, it's been just one way. Nothing catastrophic or, sort of waterfall kind of a decline. So lower start and then lost a little bit more from that point on. Europe, I looked at European markets. They are seeing some cuts as well. And, US futures are trading a little lower. So this has got some global color as well. And that is red too. Now, where do supports come in at? So there are 2 levels we put out for the Nifty and the Bank Nifty in the morning. The Nifty has come down to just to trade above the 50% retracement of the recent rise. When I say the recent rise, I mean the 31st of August low to the 15th of September high. 15-day basically. The 15-day move, 50% retracement of that is 19,723. And we're just trading above it. If this goes, then, the big one is the 61.8. That only comes in at about 19,600 or so. And the Nifty Bank is kind of the bigger loss here. It's pierced through multiple levels. And that is now at the Nifty Bank is now at 44,778 has been broken on the downside. That is the 61.8% retracement of the same rise from the end of August low to the 15th of September high. So for the Nifty Bank, it looks a lot worse as compared to the Nifty. So hopefully by close, we'll have the index, at least the Nifty, protecting that 50% retracement. Otherwise, you're basically looking at another 100, 150 odd points, at least from here, before some stability starts to emerge. But this does look like it's a bit global in nature. With me, my colleagues Reema and Nigel are here in the studios. Guys, hi.
Hi, we're now approaching a 500-point fall on the Nifty from the all-time high levels. On Friday, towards, in the second half of the trading session, the Nifty had hit its all-time high levels of 20,222. And now from that level of 20,222, we're, 494 points away. So almost a 500-point cut. The banks have sold off even more in the last 3 days. On the Nifty Bank, it's close to about a 1,600, 1,700 point fall that we've seen just in the last 3 trading sessions. And look at the mid-cap index. The mid-cap index yesterday also, and even in the first half of today's trading session, was holding up. It was fairly resilient. At one point of time, the mid-cap index was in the green. And then look at that fall that precipitated after 12 o'clock. That's when the slide started in the mid-cap index, and now we're at the day's low. Similarly, even for the PSU banking index, it was providing that, it was defying all odds and moving up every single day. Again, in the first half of the trading session, it was absolutely fine. And then 12 p.m., there's a cascading fall that we've seen in the PSU banking index. The Nifty has been under pressure, Nifty sensex, through the course of the trading session. But the second half has been particularly bad for the PSU banks and even the mid-cap index. And look at the advanced decline ratio now, Nigel. We're talking about 2,000 plus stocks declining for about 700, 800 stocks gaining.
Well, the problem is the Nifty Bank. That one broke the 20 DMA, the 50 DMA as well. And today you have HDFC Bank actually that's more or less stable and defending the 200 DMA. The problem is the other couple of banking names like ICICI Bank has come in for some selling. You have the Nifty Bank now that's trading closer on 250 points lower than the 20 DMA as well as the 50 DMA. And that's the one that's putting some pressure. HDFC Bank, well, it had a big cut yesterday. Today it's pretty okay. You have ICICI Bank that's moved lower, SBI has moved lower, Axis Bank as well. All of them, they are dragging the index a little bit. The question is, how do you position yourself in the final hour of trade? We'll have the Nifty weekly expiry as well that plays out. Mitesh Thakkar is back with us. Hi Mitesh, well, it's been that sort of a day, right? If you took a long trade, well, you'll be very disappointed. But what would your trade be at, getting into this final hour of trade? Do you see some kind of bottoming out, or do you think we're in for a deeper correction on the Nifty and Nifty Bank?
I think, see the Nifty, we were penciling in a target of around 19,750 and we have been trading around that level. If you look at the intraday hourly charts and half hourly charts, you will see that while the candles have made a fresh low, this candle itself is the middle low of 17,916. It's not significantly lower than the 19,750 mark or the other intraday hourly candles. So waiting it out, I think if it breaks 19,700, I would then look at more correction. But what is very interesting is that on the upside, now I think getting past 20,000, 20,050 in the short term would be a very demanding and a challenging task. So this texture in the short term would now possibly be sell-on rallies. If you get pullbacks to about 19,900, I would start selling by buying some put options or having a negative delta position. And closer to about 20,000, I would even want to venture and aggressively short the futures side. So that's the way we'll approach it. Coming on to the stock side, I have a sell on Gujarat Gas. Keep the stop at about 447.5. Look for a target of around 430. And ICICI Bank is the other one, which I would recommend selling with a stop at about 971 for targets of around 940.
Sorry, could you, Mitesh, Gujarat Gas was one and you said ICICI Bank?
That's right.
Sorry?
Gujarat Gas and ICICI Bank.
Okay, all right, fair enough. And on the Nifty, basically yesterday's high, right? I mean, there was a gap between 19th and 20th. That's essentially where, any bounces will get sold?
Yeah, exactly. So I think that is the level on the upside. Basically, the yesterday's, today morning got a gap down, but yesterday's gap is even more significant because that came at very extremely overbought level. So I think in the short term, getting past that high of 20,050, which was intraday pullback high of yesterday, would be very, very difficult in the short term to fill that gap. So I think any rallies closer to about 20,000 for me would invite selling in the futures market directly on the index, and a pullback to about today's gap, which is about 19,900, which is yesterday's low. Around that level, I would want to buy some put options at least.
Okay, all right. Mitesh, thank you. Thank you for that. Appreciate it. And we'll keep coming back to you. Adrian Movat is now joining us. He's a veteran, looked at global sort of macros, markets for a long time. And of course, based out of Hong Kong now. Adrian, good to have you with us here. Thank you very much. So the market here in India has been one of the better performing ones globally. Actually one of the best performing ones, not even better. So one can, some corrections, some pullbacks, etc., do come in from time to time. This could be one of them. My question to you is that apart from that factor, which is like a routine pullback, is something sort of happening in global markets which we should sit up and take note of. The dollar has been higher against, I think, widespread expectation. Yields across the curve in the US are hitting new highs, at least on a closing basis. So just wanted that perspective from you. What's going on?
Yes, I think, you hit on the key factor here, which is the bond market. And so we've had a bond market where the yield curve has been the most inverted that we've seen since the 1980s when Volcker was in Powell's position as chairman of the Fed. Now, at one point, Volcker had pushed the Fed funds rate to some 20%. And so you ended up with a yield curve that's inverted by about 1.5%. Now, today, obviously, we have high Fed funds rate, but they're high at 5.5%, not at 20%. And we've got a yield curve that has a bond, has an inversion of about 1.1%. Now, that seems extremely sort of bearish in terms of the economic outlook. If you feel that, yield curves really indicate what's going to happen with the economy, I would suggest that the yield curve is wrong, that the U.S. economy is proving to be more resilient. And so the pain trade for this year has been for the bond investors. So all the sort of major government bond indices are down year to date. And the pressure is for investors to take money out of bonds. So I think yields will push higher. And as yields push higher, that supports the dollar. It is less competitive as this discount rate moves higher. So I think that's an important pressure point. I also, add that, the pessimism around China, if anything, is building some momentum. And, India is an emerging market. It's a major emerging market, but the largest emerging market, even with the underperformance of China, is China. And so when you talk to emerging market fund managers, they are seeing redemptions. I think India is part of that story. Before you get overly pessimistic about that, it's very important just to come back to your local fundamentals. You have one of the stronger economies in the emerging market. You're the fastest growing major economy. You don't have a particular issue with inflation, and your current account looks okay. Maybe there's a little bit of short-term pressure as the oil price moves higher. So I think India is sort of suffering a bit of collateral damage rather than specific issues for India.
Adrian, this is Rima here. You said emerging market funds are seeing redemption pressure and India is a part of that. Do you want to put some numbers to the extent of outflows that we've seen from emerging market funds, and the collateral damage, therefore, that India has been facing? And secondly, have you been following the news flow that, there are some rising tensions between India and Canada? Is that in any way affecting the Indian equity markets and the fall that we're seeing, for instance, today because of the escalation?
So for the latter one, I don't believe so. I think the economic relations between Canada and India are more modest than other bilateral trade points. So equity investors tend to look through these situations. I don't have to hand the exact numbers for emerging market outflows, but they are definitely outflows. And remember that quite a lot of people buy into passive products. So they bought emerging markets through an index product. So as China drags the indices lower, then that drives, broad redemptions, which India will get hit by. I mean, it's interesting, if you think about some of your big global blue chip stocks that have ADRs, such as HDFC, to some extent, you're seeing more pressure in these, classic holdings for big long-only funds.
Hi, Adrian. Adrian, I recall when you joined us last, you said that India could be in a phase of consolidation post the recent run. Do you think, given the kind of cues that we're getting from the Fed, the global setup as well, crude oil prices moving up, could it now be in for a bit of a correction?
Yes, I think it's quite possible. I mean, for fear of being sort of overly focused on calendars, seasonally, September, October can be periods of consolidation in global equities. India's had a good run. People are sitting broadly on some profits there. So it's probably tactically vulnerable. But I go back to my previous point. It's, for the long-only investor, you probably should be looking through this. I'm not sure if it's a big enough tradable pullback.
Not a big enough tradable pullback. I mean, so basically, more like a short-term whipsaw, Adrian.
Yeah, so I think there's this pressure which goes back to the fact that the U.S. economy is proving to be quite resilient. inflation is falling, but it remains above the level that the central banks are comfortable.
Right. Sorry, are you there, Adrian?
Can you hear me? Can you hear me?
Yes. Please go on.
Hello.
I thought go on, Adrian.
Yeah. So there was too much. There was too much a consensus around the U.S. economy slowing down and the Fed cutting rates quickly as we went into 2024, and so we're readjusting that outlook. So there's a bullish part of that outlook, which is that the economy is better, and the bearish part is that short-term interest rates are going to stay above 5% for longer than the bulls on the monetary cycle were hoping for.
But okay, got that. And you were just to sort of you said that it's most likely the case that the yield curve inversion in the U.S. is you said you believe it's wrong. I mean, it's not. In that sense, this time is different. It's not indicating a recession.
Yes, I think it is wrong, and I think it is wrong because we are moving from the post-GFC, post-Euro crisis period of expansion in central banks' balance sheets, European Central Bank governor doing whatever it takes, to one in which we've got the quantitative tightening, a shrinking of balance sheets, inflation above central banks' targets, deteriorating fiscal positions, and those that are anchoring on the bond yields that you've seen since the early 2010 have got it wrong. And I think it's that anchoring behavior that's got long-term bond yields at this level, rather than some divine view about how the economy is going to turn out in the United States. So the pain trade is that bond yields are moving higher and that the yield curve shouldn't be inverted at this stage.
Adrian, great conversation. Thank you very much for joining in. In fact, let's stick with this story. The Fed's hawkishness has pushed up U.S. 10-year bond yields by nearly 10 basis points to 4.33%. Yet, the Indian 10-year yield has risen by only 1 to 2 basis points. The dollar index, too, let's pull that up. The dollar index has risen by 70 basis points to 105.44, but the rupee has fallen by only 0.05%. So let us hear to tell us why the Indian market reaction has been a bit muted compared to what we've seen in the US.
Well, the big chatter in the Indian bond and rupee market is the likelihood of Indian bonds getting included in the JPM bond index. So you can see the very muted reaction despite a 10 basis point rise in US 10-year yields. The Indian yield actually went up by 2 basis points, and towards close of trade, even that got mellowed to perhaps 1 basis point at the most. And the expectations stem from the fact that the announcement usually comes in the end of September, effective or first week of October. And that's why as we get closer to the end of the month, the chatter gets louder. There isn't any new information, but people reiterate what they heard, what they have been hearing. One, that the bond investors, funds which follow the index, when asked by the index providers around August, that letter went to them, they have responded overwhelmingly in favor of inclusion of India, and the chatter grew after China and Russia became practically uninvestable. The second reason is that JPM itself put out a report saying that now they're able to adjust and do the clearing for a withholding tax. So they should be able to adjust other taxes, is the argument. And India has been under watch. You can't keep a country under watch for years. It's already over a year. So a decision has to come one way or the other. And at the moment, the India story is so strong that it would make more sense to include. That's what the market chatter is trying to convince itself. I want to repeat that there is no new information that has come from the index providers, but the market is simply so sure or getting increasingly sure that this may work in favor of Indian bonds, which is why we are seeing hardly any impact on Indian bond yields from an action that should have been extremely, negative for Indian bonds as well. If nothing were to come by October first week, we can see a very big jump in Indian yields, maybe 5-10 basis points in the very least. But at the moment, the markets are in the grip of this expectation. Likewise, ditto for the rupee market as well. As you know, the dollar index has surged, but the rupee is barely weaker. Dollar is stronger by about 5-6 paise compared to the overnight close. And here again, besides this expectation, the traders tell us that Reserve Bank also has been providing dollars, selling dollars, and this is working to a double plan. It is smoothening the likely depreciation of the rupee. The Reserve Bank also wants to remove excess liquidity in the system. They have made that abundantly clear by the incremental CRR that they had announced. Now that that is going away, they're using other means to keep liquidity tight. And so this selling of dollar is working to Reserve Bank's overall game plan, is what traders tell us. But the important point is a lot of dollars is expected to come into the system if the index inclusion happens. That's another reason why the market itself doesn't want to short the rupee. So that's the big news in the bond markets, not the Fed, the bond index.
Okay, all right. Absolutely. Same time last year, Lata, this similar kind of expectations, right?
But that's the time the chatter started. So now everyone's feeling is, we have been in watch for 1 year. You can't keep us endlessly on watch.
I remember I did a piece back then,
Yes.
and then it was supposed to happen that weekend, didn't happen, and then yields did move up.
Yes.
As you said. So, we'll see. But that's the big one, absolutely, no doubt about it, if it does indeed happen. Also remember, from the time of announcement to the time of inclusion, there is expected to be a large, if the announcement happens, the inclusion...
Give it in stages, right?
It'll happen with some time lag. Lata, thanks very much for that. We'll take a very quick commercial break here. We are back. Deven Choksi will be with us. Rupen Rajguru will also be joining in for some market conversation. Stay with us.
Welcome back. At the day's low, 19,722, approaching a near 200-point fall on the Nifty. One of the big stocks of the day on the way down has been SJVN. It's a 13% fall in the stock price after the government announced that they are considering an offer for sale, an OFS, where the government will be selling their holding in SJVN. So it just, brought my attention to the Mahesh Nandurkar note from Jefferies, which came out yesterday. And he says fiscal pressures are building up with oil prices rising. Expenditures in an election year are difficult to trim because it's an election year. And thirdly, slowing nominal GDP and rising oil prices may restrict tax revenue surprise. So revenues are dwindling, fiscal pressures are there, and expenditures remain constant. And therefore, he says potential reallocation towards social spending might drive incremental pressure on PSU divestments. That's the statement made. His view is that the government will be tempted to look at some of these PSUs for disinvestment because up until now, the proceeds from disinvestments are way off their target. So far, the government has raised 5,600 crore. Their target is 51,000 crore rupees. And we've been highlighting how the government is sitting on a lot of money, right? X of the banks. This is the government holding in many of the other PSUs which have done very well. IRFC, Mazgaon Docks, Hudco. The government holding is well above 80%. And these are stocks which have gone up 100 to 350% in some cases. Now, this is what's happened with the recent offer for sales. Now, in March, the government had sold stake in HAL. They sold it at a price of 2,450, but the stock today is close to 4,000 rupees. Coal India too, the stock price has gained about 25-30% higher than the offer for sale, which had taken place in June. And the last one is RVNL, where the offer for sale took place in July. Again, the stock price, despite the supply pressure, is actually much better than the offer for sale price. So just wanted to put some of these points on the table. Deven Choksi, director of KR, Dr. Choksi, FinServ, is with us on the show now. Deven, afternoon. SJVN, people were scrambling to buy SJVN. Today, the stock price is lower by close to about 12.5%. Is it attractive, according to you, at these levels?
So, Nima, given the kind of valuation at which the stock is quoting, and I think if you look at the performance, financial performance of the company in the previous quarter particularly, I think one is not getting full clarity about the financial performance going ahead. And that's where I believe that I think even if I think one has sold this particular shares about 5% of the quantity at a discount, still I think the valuation remains in the vicinity of around 27 times price earning ratio. So I think that could possibly be a factor which probably will have to be looked at if the company is not reporting consistently improved finance performance. Then possibly I think one is not arguing for buying this stock immediately in the portfolio. We'll have to wait for, I think, how they improve the performance.
Hi, Deven. Good afternoon. Deven, I wanted to ask you about some of these FMCG companies. We had the management of Dabur that just joined in close to around an hour or so ago, and they were suddenly sounding quite positive about the rural expenditure, picking up. It's coming back in a way. They said maybe a year or so ago, urban was driving consumption, but now rural as well has come back. Your view on the FMCG space, and if at all, any view on Dabur?
So, yeah, Nigel, good afternoon. Well, I guess I think the entire pack possibly is driven by the higher amount of spending in the rural consumption, rural areas, and particularly because of, I think, higher amount of disposable income in the hands of the rural masses. So that's definitely positive. Fortunately, I think the inflationary pressure on the cost, I think, has remained under control. And at the same time, it has once again allowed most of the FMCG companies to go back to original weight at which I think they've been selling the products. Vis-a-vis, I think, the reduced weight, I think, in which they were selling when the inflation was high. So I think to a greater extent, I think the rural demand is one factor, and inflation for the profit margin side is another factor, which is working in favor of most of the FMCG companies. Having said that, we don't expect very significant jump in either the volume or in the revenue, but we do believe that I think the growth would remain steady and sustainable going forward as well. Currently, the valuations are definitely at the higher side. I would always prefer, I think, companies which are high valued but having good potential to buy them when the market gives a price correction. And at this point of time, I think we certainly want to wait for the price correction to happen If at all that does happen, that probably would be a good opportunity to buy at lower levels.
Devin, there is some chatter that Glenmark is likely to sell a controlling stake in Glenmark Life Sciences. And, Vivek, our colleague, has picked up from his sources that Nirma is likely to be the buyer of this controlling stake in Glenmark Life Sciences. Your thoughts on Glenmark, because this stake sale will help it reduce its debt. And how do you think Glenmark will fare? Any thoughts on the possibility of, Nirma being the buyer and what the synergy is or what it brings to the table for Glenmark Life?
So honestly, I think who could be the buyer, I think whether it would be the private equity fund, the financial investor, or it could be, I think, any strategic investor buying into the company. That is something which I'm not in a position to put across a view on that. However, having said that, I think Glenmark's particularly, I think if this particular funds are getting realized and it should be a sum of close to around 3,000 crores odd, I think it could possibly mean a good sign for a company like Glenmark, who is basically having higher debt portfolio. And given that kind of size of money coming to them, maybe I think currently the business situation demands a higher amount of penetration into the markets through the generics and specialty generic portfolio that it carries. So certainly I think the debt is becoming hindrance at this point of time in the balance sheet. And if this money comes into balance sheet, then probably I think the market would be far more happier in giving better valuation to the company. Of course, in last couple of months, I think we have seen a steady rise in the stock price of Glenmark. Maybe it is factoring into account this particular possibility. So not completely sure, even if I think they end up parting the controlling stake, how much it will further lead to rally, because current valuations are reasonably adequate or maybe expensive at this point of time for the company.
Okay, all right, Devin, thanks so much for stopping by and answering a few of those questions. Wishing you a good evening ahead. Well, let's move on. Let's get in Rupen Rajguru, Head of Equity Investment and Strategy, as Julius Baer, who joins us on the show. Hi, Rupen. Good afternoon. Thanks so much for joining in. Well, the market's a little bit nervous going by, the global cues in particular, as well as maybe we ran up a little ahead of ourselves. You don't expect a big drawdown on the index because you've mentioned that a lot of money is waiting at the sidelines and maybe now consensus is turning cautious. So normally they get it wrong. But in a worst case scenario, what kind of a pullback can you see on the headline index itself?
Okay, hi. Good afternoon, Nigel. So as you very rightly said, this year everybody has been waiting for two things. One is a correction into the Indian markets, and two is recession in the US. And usually when the entire world is prepared for that, it does not happen at that point of time. Eventually it might happen, but probably when everybody is prepared, it does not happen. So here, the other distinct feature as far as Indian market is concerned, specifically in last 6 months, has been this phenomenal rise in the small and micro caps. While I would not mid caps have rallied, but the rally in small and micro caps have been kind of amazing. So as you rightly pointed out, we just did an analysis roughly as of August end. The Indian mutual funds were sitting on cash of roughly 80,000 crores. All the equity funds plus the balance funds put together were sitting on cash of 80,000 odd crores. So almost $10 odd billion of cash is there. So hence, probably at every fall, we are seeing the buying coming through, plus the SIP of almost $1.5 billion is there. So in that context, we don't see a big drawdown at the index level. Probably, as I said, from an intermediate high, always 5-7% correction is given. But I would definitely sound caution bells, specifically around small caps and micro caps, because some of those names have just gone off the roof. And usually the participation of HNIs and retail is very high in that. And historically, whenever people enter into narratives of kind of stories which probably are very short-term stories, it doesn't end up well. So I would caution around that segment of the market.
By the way, the selling is picking up in some private sector financials. So Kotak Mahindra Bank is down 2%. ICICI Bank has slipped some more, edging towards a 3% fall. HDFC Bank, on the other hand, is staying tight at that 200-day moving average. 1550 is the level on HDFC Bank, 1554 on HDFC Bank, and the 200-day moving average is 1550. So in the last few minutes, some of its peers like ICICI Bank, Kotak Mahindra Bank are reeling under pressure, coming in for some more selling, but HDFC Bank has not cracked below the 200-day moving average. Keep your eye on that. Rupen, afternoon, private sector financials, and you've been maintaining that there is value there. Just relatively speaking, they've not rallied as much as some of their peers. Valuations are still fairly attractive. In the financial space, would you recommend putting money to HDFC Bank, which has been a rank underperformer, or would you still stay clear from it till the merger synergies, etc., play out?
Yeah, hi, afternoon, Rima. As you very rightly pointed out, the financials and specifically the private sector financials have significantly underperformed the index. Probably in last 1 year, they have witnessed a significant underperformance. And there are reasons like the merger issue with one of the bank and a change of guard in some of the other bank on the private sector side. So that has led to a huge underperformer of these companies which were very richly valued. So rightly there has been a readjustment which has happened. So now probably, if you see some of these banks are trading at a valuation which are at say 7 to 10 year low valuation as compared to their own history. And also at a lower valuation, if I were to purely look into PE, at a lower valuation than the index itself. So considering the growth which we expect, and we will look into those banks which has a very good underwriting skills, and some of the banks which you mentioned has excelled historically on that. And probably, as they say, you don't get good news and good price, right? So while there are no good news, but the price here definitely seems to be good. So from a 2 to 3 year perspective, this definitely makes a case to buy into those banks who have historically demonstrated a very strong underwriting skills.
Okay, banks which have demonstrated a strong underwriting skills. 170 points lower is what we have, the index, and under pressure after some time. I mean, we are going to be down. Actually, for the week so far, with 1 day to go, there is we're down about 2.25% or so. So this is, what's going on. By the way, lots of names still, fair bit on the upside as well, although it's not as robust as list. Usually it's a long list of volume-led gainers, which is, a little shorter today. Lots of names, but volumes are a little lacking if you go down. Senco is an interesting company, recent listing, a jeweler. I think I saw a report from MK this morning initiating coverage. 4% higher, 486, 487 on Senco. These names like Sirma, etc. have been doing well. Morgan came out and initiated. There is a TRF, which is a material handling company that is doing well. JP Power out of the blue, 10, 11 bucks, but 3%, huge volumes on that one. There is Nava, which is up about 10% or so. Yeah, so there is, while it's all mostly red, but there is some green in these names as well. Rupen, any individual opportunities, anything you want to talk about which stand out to you?
So Prashant, when market was in a one-way streak for last 6-7 months, so everything went up. So right now, probably if you look through the macro, which was really supportive for India. So while the macro was always good, the macro has been very supportive and liquidity has been strong. So some of the aspects are seeing some cracks, especially on the macro side. If the oil remains higher for longer, it definitely impairs the government's ability to spend, and that might have a spiraling effect. So in that backdrop, what we are looking into, companies which has valuation support, because probably companies which had earnings support has got significantly re-rated, right? So wherever company has a strong order book, has demonstrated good execution capability, has got significantly re-rated. So we are looking into those segments which has probably valuation comfort, because when the macro turns murkier, the earnings which we analysts have projected in their estimates probably might see some cuts. So we are looking into those companies which has valuation support. So it is across all sectors. So within banks there are companies which has valuation support. Within IT also there are companies which are having valuation support. So across the board we are looking into those companies which have a valuation support, wherein we mean they are trading at a valuation which are at a discount either to its own average or to the markets.
Rupan, final question before we let you go. Since you mentioned IT and pharma, you had a contra call on both of them. They seem to have worked out. Sometimes these calls are a little tricky. Would you now book some profits, or would you hold on to those positions? Because Q2 results for IT companies are unlikely to be very inspiring, and the global environment as well is still in a bit of a tizzy. Will you still hold on to that contra call or book out?
So Nigel, the noise level specifically from the US macro every day changes, right? Like case in point, today we all are discussing what Fed you said yesterday, and probably after a few days something else will come up. But if I were to purely look into data, right, because end of the day, the Indian IT also depends on how the US BFSI has done. And if I were to take like top 8 banks of US in Q2 posted a 18% growth in their profits. So at an aggregate level, these the reason why they had put a halt or pause on their spending was because there was an incidence of SVB which happened. But the overall earnings wise, they are pretty strong. So net, Nigel, IT as a segment, historically has been around 10 to 11% of the profit pool of the index. It had gone up to almost 14-15% during COVID time, has now come down to 8-9%. We believe it will go back again to 10 to 11%. So while yes, tactically when this big swings happens, it makes sense to take some money off the table. But I would say as a segment, for next 2-3 years, IT definitely a large cap IT makes a point to be there in the portfolio. And in pharma, just to quickly sum up, it's a second coming for pharma sector, and we are seeing the companies last quarter almost 25% YOY growth we had seen on an average for pharma companies. I think that spillover will be there for 1-2 quarters. So on case-to-case basis, we still are constructive on pharma, but at a big undervaluation is no longer there. So that big outperformance or overweight, we have trended down to more market weight in pharma.
Okay, all right, Rupen, thanks so much for stopping by and filling us in with your calls on the various sectors. Wishing you a good evening going ahead. Well, by the way, there's no real big 3 p.m. move that we were looking forward to. The Nifty, we started the show, it was 19,730. It's around those levels itself. And the Nifty Bank, in fact, that's moved a little bit lower. Now it's at around 44,650 odd. So that's the pain point, really, even in today's trading session. Well, we'll slip in a short break. You come back on the other side, we'll get you some buy and sell calls. Our technical experts will be back with us. Welcome back. Well, the headline index hasn't moved much, but a couple of stocks actually are moving around. Pull up the intraday chart of BHAL. The stock was in the red. It's moved into the green, so that one should come up for you. Havells as well has cut its losses, and that stock as well has moved into the green. So let's get the intraday chart up for you on the screen. And India Cements, the street was hoping that finally we'll see some kind of a corporate action the last few days. We've seen this numerous times. The stock goes to around 250, 260 odd. And from there, it sees some selling. And valuation support, but the financial performance has been lacking, and that's why India Cements, well, every time it sees some kind of weakness, we see quite a sharp correction today as well, down close to around 4% odd. Mitesh Thakkar is back with us. Well, Mitesh, give us a couple of trading picks.
Majal, I think, on the stock side, I have, in fact, India Cement as one of my STVT calls. That's STVT with a stop at about 232.5. And look for 224, 223 as a target for tomorrow. And the other one which I have is Gujarat Gas. That's an STVT as well. There was a call earlier, I think. This is STVT with a stop at about 750 for targets of around 730 to 730. Yeah.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's move on to Sudeep Bandyopadhyay, Group Chairman at Indie Trade Capital, joins us on the show. Hi, Sudeep. Good afternoon. Well, not a great-looking screen, right? Plenty of red, but par for the course after the kind of run, I think, that we have seen. A mild pullback, a few hundred points on the index. The problem is in the mid-cap space, because that ran ahead as well. So let's see whether or not we see some consolidation, or are some of those stocks going to come in for some selling. Very few stocks, Sudeep, are trading in the green. And one big underperformer with regard to its financial performance has been VIP. The sector's in focus because there's an entire unlock theme, luggage theme, travel theme as well. But this one, in terms of their numbers, has been disappointing. While the two competitors, whether you look at Safari or Samsonite, both of them have been growing well. What's your view on the stock at around that 670 rupee odd mark?
No, you're absolutely right. The unlock theme was expected to boost, and to an extent it did boost. VIP Industries did move up from much lower levels to 600 plus levels. But if you compare with Safari and Samsonite and other luggage players, I think the growth and the movement, upward movement, has been much sharper. VIP has been kind of languishing. Few triggers, I think, exist in VIP, and I believe that eventually VIP also should start moving up and provide investors good return. One is their Bangladesh facility, which is on stream, and a lot of production has moved to Bangladesh. Obviously, Bangladesh is a much lower cost production center, and that will eventually help VIP Industries in a big way in improvement of their margins. So I think, for a kind of a medium to long-term investor, it may be a good idea to pick up VIP Industries at around 650, 670 levels. And wait for 1 year. I think there will be a catch-up vis-a-vis other competitors. They are a bit much smaller, but definitely a catch-up from VIP is expected over the next 6 to 12 months.
Look at the difference in the performance of Safari Industries versus VIP. Safari in the last 12 months has gone up by 124%. While VIP is down 3%. So there is, a big, if you can just juxtapose them together, yes, you would see that Safari up 124%, but VIP in the last 1 year is down 3%. So, stolen a big march over its competitor, Safari Industries. Sudeep, today HDFC AMC has taken the nod, or it's got the RBI approval to go up to 9.5%. in terms of a holding in Karur Vysya Bank, DCB Bank, and even Equitas Small Finance Bank. Now, we know all these mutual funds are flush with cash with the kind of SIPs that are coming in, and they need to invest it in the markets. Now, if they want to invest it in any financial stock, they need the RBI's approval to go beyond the mandatory 5%. And in that, they've singled out these banks, Karur Vysya, DCB, and the other one is Equitas Small Finance Bank. So clearly their intent is that with the money that they get in, the mutual funds raise, they will invest it in these three banks. Do you like any of them? And if yes, why would you pick the one which you pick?
Well, I think one bank which I like is Equitas, definitely out of the three. there is a lot of margin improvement which is happening in Equitas. The microfinance book in Equitas still dominates, and with the microfinance industry turning around and the asset quality drastically improving over the last 6 months, I think the entire microfinance sector is in a kind of a mini boom, and the expectation is for the next couple of years, I think the similar trajectory in the microfinance space will continue. Equitas definitely will benefit in terms of significant margin improvement as well as asset quality improvement in the process. So Equitas is one out of the three names mentioned, which I would prefer to pick up if I have to buy some small bank for a 1 year plus time horizon.
Are we seeing some recovery? Well, maybe just a tad, right? I mean, a 15-20 point recovery, that's it. But nothing really beyond. Market breadth has also, I think, come up a little bit. 650 higher and 1600 lower. But this is all, relatively speaking. Otherwise, we remain down and out. Sudeep, what about any small housing finance company? Anything come to mind? Again, I mean, a lot of expectations with names like Aptus, Home First, etc., but no performance yet. Not in financials, but stock-wise.
I agree with you, Prashant. There are a lot of expectation in the entire housing finance space. And, unfortunately, the market performance of these stocks haven't been anything to write home about. With HDFC kind of disappearing as an independent housing finance company, I think there is a lot of focus on the listed housing finance space. Also, if one looks at the opportunity as far as the space is concerned, I think it's a significant opportunity with housing for all and low-cost housing being supported by government through multiple schemes. I think the housing finance companies should do well and continue to do well for a foreseeable future. Under these circumstances, I think if I have to pick up a housing finance company, probably I'll go back to the tried and tested LIC housing finance. Canfin housing finance also looks good. There have been periodically episodes of fraud which this company has reported, and that has destabilized and kind of created a lot of confusion. But otherwise, I think the performance is improving, and assuming there is no untoward incident in the near future, I think Canfin Homes also can be looked at.
Sudeep, do stay on. We need to slip into a very short break. As we do that, here is some exciting news. You can find CNBC TV 18 on WhatsApp. The best of market, business, economy and global news truly at your fingertips. You can add the CNBC TV 18 channel on WhatsApp by following a few simple steps. First, make sure you have the latest version of WhatsApp. Go to the App Store or Play Store to make sure your WhatsApp is updated. Then go to Updates. You will find a button for channels. Search for CNBC TV 18 and hit subscribe. You will get all the necessary updates right on your WhatsApp feed. WhatsApp channels is currently in beta mode, so some of you may not get this feature, but it should be available in the next few days. You can also catch CNBC TV 18 on all other social media platforms, including Facebook, X, Threads, Instagram, YouTube, and JioCinema.
Okay, welcome back. We got 150 points. So cut. I mean, a little bit of a recovery, as I was saying earlier, but not by very much at all. Sudeep Bandyopadhyay is still with us. Sudeep, briefly, I don't know if you saw that RBI data on household savings, which came through. Our colleague Ritu had put out a piece yesterday. Any thoughts on that? I mean, one point of view is that it perhaps will show up in consumption demand down the line. While right now credit growth, especially on the personal loan side, is growing very fast, has done very well, is the segment which has done the best, but not good if you look at it from a medium-term perspective. Any thoughts at all?
No, absolutely, Prashant. I think the savings, household savings, going down sharply for a country like India, which needs a lot of growth capital, may not be a very good indicator or a sign. On the other hand, if the consumption increases and people start spending, that should give a boost to the economy. So consumption sector should get a boost. Probably it is too early to decipher a trend. Maybe we need to wait a little while for this trend to emerge. Traditionally, Indian household savings have been a bulwark as far as the economy is concerned. But the nature of that is probably changing. Financialization of savings is happening in a big way. And to a great extent, the asset management companies, the insurance companies, and the Jan Dhan also has helped, because the unbanked is getting banked, and they are started to use the formal channels to use their savings. And the savings may be going in multiple directions. We need to study and see more data to get a specific or a discernible trend.
Okay, we'll leave it there then. Sudeep, thank you very much for your time. It's always a pleasure and good speaking with you. So we'll end down 150 odd points, which means we're for the day it'll be about 0.75% cut. Nifty Bank, of course, far larger, 1.7% cut there. Almost 800-point knock coming through on the Nifty Bank. And like the last 2 days, mid and small cap indices also lower. Mid cap index down about 0.9, and you have the small cap index down about 1.25%. The run up in the small cap index was far larger, and the pullbacks that we've been seeing for the last 2 or 3 days since since it started have also been a little larger as compared to what we are seeing in the mid cap and of course the large cap space as well. So we'll end at 19,746. The level which we put out at 230, I think has defended. So 723 is the 50% retracement. We'll end at about 746. Can't take too much heart, but we'll see. Come back tomorrow with maybe and hopefully a little better in terms of global cues. Rima.
Well, the low today is 19,710. So from the low, we've recovered close to about 40 points. There is a defensive tilt to the gainers today. So there are many in the IT pack, like Tech Mahindra, 1.3% higher, Infosys up 0.8%. Pharma has also done well, led by Dr. Reddy's. And remember to keep your eye on Glenmark Pharma and whether they announce the sale of a controlling stake in Glenmark Life. But IT's done well, Pharma's pretty okay. You've got consumption names which did well in the second half. So Asian Paints, HUL, Britannia. These are stocks which are ending firmly in the green. And even a company like Dabur, we had a chat with them where they spoke about rural market resurgence. Dabur has pretty much erased all its losses and is ending on the flat side. There goes the bell. And on the losing side, Nigel, it's all been about the banks, right? The Nifty Bank down 750 points.
That's right. There were a few gainers, though, Rima. Genus Spa intraday, the stock has seen a bit of a correction last few days, but midway through, you couldn't trade because that one went up close to 5%. HPL Electric was the other stock as well. So I don't know whether the street is sensing that maybe there'll be some more smart meter orders that will be coming in. So that was another stock that did pretty well. MCX, well, they're going to be rolling out the new software, so street likes that. Stock was up close to 2%. And REC, we spoke to the management yesterday. They're talking about the AUM growth, of around close to around 15%, with asset quality improvement and NIMs improving 3.5%. So on the back of that, we had that stock as well ended at the green. But that's all the time we have on a closing bell. You don't go anywhere. Our Thursday special, Big Deal, comes up next.